There was no single moment when the change became obvious. It happened quietly, in the way goods moved across borders, in the way ships were counted at ports, in the way land was measured and sold before it was ever settled. Revenue in the early American system did not arrive through direct demand. It arrived as a byproduct of movement. As trade thickened and territory expanded, money flowed toward the government almost incidentally, as if the system had been arranged to collect without asking. At first, this seemed not only efficient, but natural. A nation positioned between oceans, rich in land and dependent on maritime exchange, could lean on its edges rather than its interior. Ports became the quiet arteries of public finance. Duties were placed on goods as they entered, small impositions justified as the cost of access. They were visible, but distant. For most citizens, they existed somewhere else, folded into the price of imported cloth or tools, rarely traced back to the treasury. The arrangement created a certain kind of psychological distance. The government did not appear as a collector standing in front of the individual. It appeared as a presence at the boundary, intercepting commerce before it dispersed. This mattered more than it seemed. Systems that collect at the edges tend to feel lighter, even when the total extracted is significant. The burden is diffused, obscured by layers of exchange. Over time, another current began to form beneath this structure. Land, vast and unsettled, became more than territory. It became a financial instrument. The government, holding large tracts acquired through treaties and expansion, converted space into revenue. Parcels were surveyed, divided, and sold. Each transaction was a transfer not only of ownership, but of funding. Growth itself became a source of income. This created a pattern that felt self-sustaining. Expansion produced land sales produced revenue. Revenue supported the state that enabled further expansion. For a while, the cycle held. It gave the impression that the system did not need to reach inward, that it could continue to rely on what lay beyond the individual rather than within his earnings. But beneath this apparent stability, there were dependencies forming. Trade volumes had to remain strong. Borders had to stay open enough to sustain imports. Land had to remain desirable. Buyers had to keep arriving, and the frontier had to keep moving. None of these conditions were guaranteed, but for a time they aligned just enough to make the system appear resilient. There were moments, even early on, when the structure showed strain. Wars disrupted trade. Blockades tightened the flow of goods. Revenues contracted, not because policy changed, but because the underlying activity slowed. In those moments, the government was forced to look elsewhere, experimenting with internal taxes that were often met with resistance. These were not just economic reactions. They revealed something deeper about the system's design. A government that relies on indirect flows is always tethered to external conditions. When those conditions falter, the absence of direct mechanisms becomes visible. The system must either adapt or endure instability. Early American leaders were aware of this tension, though they often treated it as temporary, assuming that peace and expansion would restore the balance. For ordinary people, the experience remained largely unchanged during these early decades. There was no routine accounting of personal earnings submitted to the state. There was no recurring calculation tied directly to individual income. The government's presence was felt in prices, in transactions, in the gradual shaping of markets, but not in the private ledger of each citizen. This distance fostered a particular expectation that the state could exist, function, and even grow without placing its hand directly into the income of its people. It was not framed as an absence, but as a continuation of a pattern that seemed embedded in the nation's design. A system built on movement, on exchange, on the outer layers of economic life. Yet systems built this way carry a quiet condition. They depend not on stability alone, but on continuity of specific behaviors. Trade must continue to flow in certain patterns. Expansion must remain viable. Consumption must sustain the mechanisms that generate revenue. When these behaviors shift, even slightly, the effects do not appear immediately. They accumulate, gradually altering the balance. By the time these shifts become visible, they are often mistaken for sudden change. In reality, they have been forming for years, embedded in decisions that once seemed minor. Adjustments in tariffs, fluctuations in land demand, interruptions in trade routes, each leaves a trace. Over time, these traces begin to align, revealing that the system was never as insulated as it appeared. The early American funding model was not an absence of taxation. It was a different relationship to it. One that relied on distance, on indirect collection, on the assumption that growth at the edges could sustain the center. For a while, it did. But the conditions that made it possible were never permanent. They were simply aligned, temporarily, in a way that allowed the system to function without asking directly. As the early structure settled into place, it began to reveal a pattern that was less about policy and more about positioning. What revenue was not simply collected, it was intercepted. The government stood at points where economic activity converged. Ports, land offices, licensing systems, and allowed the flow of commerce to carry its contribution with it. This was not accidental. It reflected a broader principle that had appeared in other periods of history, often in empires that relied on trade routes rather than internal extraction. In such systems, the strength of the state is closely tied to the volume and direction of movement. When goods pass through controlled points, small percentages accumulate into substantial sums. A tariff of a few cents on imported goods, multiplied across thousands of transactions, produces a steady stream. The individual payer rarely feels the full weight, because the cost is embedded within a larger exchange. It is dispersed across consumers, merchants, and intermediaries, diffused until it becomes difficult to isolate. This diffusion is what gives the system its initial stability. It reduces resistance because it avoids direct confrontation. People do not experience a single moment of payment. Instead, they encounter slightly higher prices, marginal adjustments that are rarely traced back to a central authority. The system functions quietly, almost invisibly, as long as the underlying flows remain intact. But this same characteristic introduces a structural vulnerability. When revenue depends on movement, any disruption to that movement has immediate consequences. Trade restrictions, international conflict, or even shifts in domestic consumption patterns can reduce the volume passing through those collection points. The system does not fail all at once. It thins. The streams narrow, and the accumulation slows. In early America, this became evident during periods when maritime activity declined. Customs duties, which had once formed the majority of federal revenue, began to fluctuate. The government's income became less predictable, not because tax rates changed, but because the base itself was unstable. A system built on external flows cannot fully control the conditions that sustain it. Land sales followed a similar pattern, though their mechanism was different. They relied on anticipation rather than movement. Buyers purchased land not only for immediate use, but for future value. This created waves of demand that could rise quickly and then recede. During periods of optimism, land revenue surged. During periods of uncertainty, it contracted. The government's finances, tied to these cycles, reflected the same volatility. What emerges from this is a broader structural insight. Funding systems that avoid direct taxation often shift their dependence onto variables that are less stable. Trade volumes, land speculation, resource extraction. These can generate substantial revenue, but they are sensitive to conditions beyond the state's immediate control. The apparent ease of collection is offset by the unpredictability of supply. This pattern is not unique to one nation. It appears wherever governments rely on indirect mechanisms. In medieval trade cities, tolls on goods entering gates funded local authorities. In colonial administrations, duties on exports and imports sustained imperial structures. In each case, the system functioned as long as the flow continued. When it slowed, the absence of alternative mechanisms became more pronounced. In the American context, there was also a philosophical dimension to this arrangement. The reluctance to impose direct taxes was not purely economic. It was tied to a broader skepticism of centralized authority, a desire to limit the visible reach of government into individual lives. Indirect funding aligned with this sentiment. It allowed the state to operate without appearing intrusive. Yet, philosophy does not eliminate constraint. It shapes the design of systems, but those systems must still respond to material conditions. As the country grew, the scale of its needs began to change. Infrastructure expanded, administrative functions increased, and the cost of maintaining a larger territory became more complex. The original mechanisms, while effective in a smaller and more fluid environment, began to encounter limits. At the same time, the economy itself was shifting inward. Industrial activity, domestic production, and internal markets were becoming more significant. The center of economic life was no longer confined to ports and frontiers. It was spreading across cities, factories, and emerging networks of labor. The existing funding model, focused on edges and expansion, was not fully aligned with this new structure. This misalignment did not produce immediate crisis. Instead, it created a gradual tension. Revenue sources that had once been sufficient began to feel constrained. Adjustments were made, tariffs were modified, land policies were refined, but these changes operated within the same framework. They addressed symptoms rather than the underlying shift. There is a tendency in such systems to extend familiar mechanisms beyond their optimal range. When a method has worked in the past, it is often adjusted rather than replaced. This can delay more fundamental changes, but it also increases the strain on existing structures. Over time, the gap between what the system can generate and what it needs to support becomes more visible. In this way, the early American funding model reflects a recurring historical pattern. Systems that rely on indirect, externally dependent revenue can sustain themselves for extended periods, particularly during phases of growth and expansion. They feel less burdensome, less intrusive, and more aligned with certain political ideals. But they carry an inherent trade-off. Stability is contingent, not guaranteed. As conditions evolve, the balance shifts. The very features that once made the system effective, its reliance on movement, its distance from the individual, its dependence on expansion, begin to limit its adaptability. The state, still operating within its established framework, must confront a reality that the original design did not fully anticipate. The transition that follows is rarely abrupt. It unfolds through a series of adjustments, each responding to immediate pressures while gradually altering the structure. By the time the pattern becomes clear, the system has already begun to change, not through a single decision, but through the accumulation of responses to conditions that could no longer be managed at the edges alone. What becomes visible, only in retrospect, is how long the conditions for change had been forming before any formal shift occurred. The system didn't collapse under the weight of a single failure. It adjusted, repeatedly, each time absorbing strain in ways that seemed temporary. Small measures appeared during moments of pressure. Temporary internal taxes, short-term borrowing, revised duties, each framed as an exception rather than a redefinition. This gradualism is characteristic of funding systems that are deeply embedded in a nation's identity. Early American finance was not just a mechanism. It was an extension of a belief about how a government should relate to its people. To alter it directly would have required more than policy. It would have required a change in how the state understood its own reach. So the system stretched instead. During periods of conflict, especially, the limitations became harder to ignore. Wars do not wait for trade cycles to recover or land markets to stabilize. They demand immediate resources, often at scales that exceed what indirect systems can provide. In those moments, the government turned inward, not out of preference, but necessity. Internal taxes were introduced, then often withdrawn once the pressure subsided, as if the system could return to its earlier form once the disturbance passed. But each instance left a residue, not only in the form of policy precedent, but in institutional familiarity. Mechanisms that had once been considered intrusive became, over time, more administratively feasible. The idea of reaching into the internal economy did not arrive suddenly. It was rehearsed, quietly, in fragments. At the same time, the broader environment continued to shift. Trade, once the dominant channel of revenue, became more complex and less predictable. Global conditions influenced domestic stability in ways that were difficult to manage from the edge alone. Land, once abundant and easily converted into revenue, approached its practical limits as a financial resource. The frontier, which had once absorbed expansion and generated income, no longer moved with the same pace or certainty. Inside the country, economic life was becoming more concentrated and measurable. Wages, profits, and industrial output created forms of value that were not easily captured through tariffs or land transactions. The center of gravity had moved inward, even if the funding system had not yet fully followed. This created a quiet imbalance. The government's responsibilities were increasingly tied to internal structures, roads, regulation, administration, while its revenue remained partially anchored to external flows. The mismatch did not produce immediate failure, but it introduced a persistent tension. The system was supporting a modernizing state with tools designed for a more fluid, outward-facing economy. When systems reach this point, change rarely arrives as a clear decision. It emerges as a series of recognitions that certain methods no longer scale, that reliance on external conditions introduces risk that cannot be fully controlled, that the distance between the state and the individual, once seen as a strength, may limit the system's ability to respond to new demands. The introduction of more direct forms of taxation, when it eventually came, did not represent a rejection of the earlier model as much as an acknowledgement of its boundaries. The earlier system had worked under specific conditions: abundant land, expanding trade, a smaller administrative scope. As those conditions shifted, the system adapted, not because it had been designed to do so, but because it could no longer rely on what had sustained it before. For individuals, the change was less about policy language and more about experience. The relationship between citizen and state became more immediate. What had once been absorbed indirectly through prices or distant transactions became visible in personal accounts. The sense of distance narrowed. The government was no longer positioned only at the edges of economic life. It had moved closer to its center. Institutions, too, evolved in response. Systems for measurement, reporting, and enforcement developed alongside the new methods of funding. These were not merely administrative additions. They reflected a deeper integration of the state into the internal economy. The shift was structural, even if it appeared incremental at each step. Looking back, the earlier period can seem unusually simple, almost detached from the complexities that followed. But that simplicity was conditional. It depended on a convergence of factors that were never permanent. Once those factors changed, the system adjusted, not all at once, but steadily, in ways that only became clear over time. There is a tendency to view such transitions as choices made at specific moments. In reality, they are often the outcome of accumulated conditions that narrow the range of viable options. By the time the shift becomes visible, it has already been prepared by years of subtle change. The early American model of funding without direct income taxation was not an absence of burden. It was a different arrangement of it, one that placed its weight on movement, on exchange, on the outer layers of economic activity. It worked for a time because the structure of the economy allowed it to. When that structure changed, the system followed, slowly at first, then more decisively. And in that movement, the original distance between the individual and the state did not disappear. It was redefined, shaped by new mechanisms that reflected a different set of conditions, no longer anchored at the edges, but drawn inward, where the flows of value had come to settle.